Can't talk to anyone. Can you hear me? Can anyone hear me? How do I know when I'm on?
Good morning to everyone. You are joining the LABC webinar this morning. I'm Mary Leslie, the president of the Los Angeles Business Council. There's over almost 500 people are registered for today's event, and thank you for joining us. Like most of you, the LABC Institute went mobile about 5 weeks ago and had to reinvent how we talk to our members and our friends. Since we cannot convene in person, we have launched this webinar series. We began focusing last month on the issues we thought were most critical as part of the COVID response. For us, that was focused on homelessness and housing, and we hope you can join us for this series that will continue again next month. But today, we're talking about economic development. What is going on in the state? What is going on in the country? And we're so pleased to have the group of experts with us that we have today. This webinar is launching with a series of experts, beginning with Emil Haddad, Chairman and CEO of 5 Point, Stuart Gabriel, the Director of the Ziman Center at UCLA, and Victor Parker, the District Director for the Small Business Administration. We would like to, we're very proud of him. We'd like to congratulate Emil Haddad today for his appointment to the Governor Newsom's new task force on business and job recovery. Emil, you're going to be a wonderful addition to that task force, given your way of thinking about what the economy should look like and the creative way you approach things. You are also joining two of the task force co-chairs that the LABC has been fortunate to work with, Tom Steyer and Ann O'Leary. But today, I'm proud to be able to introduce today's MC, who is Richard Ziman. He is the founding chair of the Los Angeles Business Council and our current vice chair. Many of you know him as the co-founder of Rexford Industrial Realty, one of Southern California's leading industrial infill real estate companies. He was also the founder and largest owner of a company called Arden Realty, who sold to GE several years ago on one of the largest transactions in the region. He is also the founding chair of AVP Partners, the exclusive advisors to American Value Partners, a $400 million institutionally sponsored fund to funds. Richard is also the CEO and co-trustee of the Rosalind and Arthur Gilbert Foundation, one of the largest here in Los Angeles. And my personal favorite is that he was the chair of the City of Hope Board for over 6 years, where he was able to help them refinance and expand dramatically, making them one of the most important medical facilities in the country. Also, pertinent to today's discussion, Richard founded the Ziman Center for Real Estate at UCLA, and we are very grateful to have his leadership at the LABC and his knowledge and experience in this time of uncertainty. So today, Richard will lead the discussion. He'll introduce our panelists, and if there's time, he'll ask questions. Richard.
Thank you, Mary, and welcome everyone to the first in a series of LABC Zoom Spotlight webinars on the impact of COVID-19 on our national and particularly our California economy. Believe it or not, we have almost 500 participants today, including several national reporters. We're also honored, as Mary indicated, to have 3 experts from business, academia, and government with us to share their perspectives. We'll begin with a business perspective from Emil Haddad, Chairman and CEO of 5 Point Holdings, followed by Stuart Gabriel, as Mary indicated, and then Victor Parker, who is our Los Angeles District Director, the United States SBA Small Business Administration, and a guy who is truly in the spotlight. Each of our panelists will share their perspective on how COVID-19 is impacting the way we do business, what the economic modeling looks like now and what it looks like in the future, and the status of the federal government's most robust program for the Paycheck Protection Program, known as PPA, and especially Victor will address the hopefully to be approved additional $300 billion for the very small businesses through the SBA. I would encourage all of our participants joining today's call to submit your questions to the panelists presenting using the Q&A feature at the bottom of your screen, and we will have time for questions and answers after the presentations. With that, I would like to begin today's program with Emil Haddad. Emil, as Mary indicated, is chairman and CEO of 5 Point Holdings and a member of Governor Newsom's newly formed California Economic Recovery Task Force, formed to help jumpstart the state's economy in the wake of this healthcare crisis. 5 Point is one of the largest developers of large mixed-use master plan communities in coastal California with projects in Orange County, LA County, and San Francisco County. Founded in 2009, 5 Point combines residential, commercial, retail, educational, and recreational elements with public amenities, including civic areas for parks and open spaces, and to build communities in 3 of the most dynamic and rapidly growing markets here in California. 5 Point is currently entitled for 40,000 residential homes, including 6,000 affordable residences, very important, and approximately 23 million square feet of commercial space in its communities. And with that, I'd like to turn it over to Emil. Emil. I can't hear him. May I hear? Come here. I can't hear.
Everyone can hear him.
Richard,
Yes.
I think that Emil is having technical difficulties. You should go straight to Stuart Gabriel and we'll come back.
Okay.
Can you hear me now, Mary?
Oh, now we can.
Perfect. Thank you. You're with us.
Okay.
Good.
All right, perfect. Well, I sounded brilliant before when you were not listening to me. So what I was saying is I think we are living in unprecedented times, both globally as well as nationally. And I will make the distinction. Globally, we're living in unprecedented times, notwithstanding the fact that we've had pandemics all through history, but we've never had a pandemic in a global economy that is so intertwined with extremely complex supply chains that are driving a just-in-time delivery model. What that means is that when we ended up starting this and the disruption of the supply chain started becoming apparent, we had no inventory and there was no redundancy in this chain, in the system itself. And that's why we started seeing supplies disappear. And I believe that that's what added a lot to the panic of the consumers when that started happening. On the national front, we in this country have never gone through something like this. This is the first time the US public goes through something like this versus some other parts of the world. And I can tell you, having gone through my previous life in the civil war in Lebanon, I can make the distinction. Now, what that ends up happening here, in my opinion, is that ended up creating a longer period of denial before we started getting the public to accept. And as a result, I think we aggravated the situation here. So now the question that's on everybody's mind, that everybody's talking about, is how do we reopen an economy? And I think that one is we have to draw a distinction between the US and most of the other countries that are ahead of us in opening an economy. Every other country in the world that has started opening an economy had two things to balance: health and economy. We have a third element that is equally important that we have to look at, which most of the world doesn't have, and that's constitutional rights. And then today, you're starting to see a lot of people focus on that side. So for whoever is going to make a decision to reopen the economy, they have that third dimension that they have to keep an eye on. That's one factor that is different. Two, we have the election noise that I think is creating a lot of confusion, and we are not being able to get all of the data in a pure way, which unfortunately between now and the coming few months, it's only going to get worse, and it's going to make it much more difficult for decisions to be made objectively. Third, almost every country that has gone through and started reopening had a much more robust testing program. And we haven't had that yet. Now, I'm not a doctor, and I don't know whether testing is helpful or not helpful. But I know that psychologically, we have a consumer today who needs to be convinced as to why they need to go back to a restaurant and why they can get on a plane. And I think the concept of testing gives people more comfort that they're safe. Very similar to when you go through, security at an airport. It might not stop every terrorist act, but you feel more comfortable getting on a plane that people have been searched. The other thing that I think is going to be important to look at is what is the real number of job loss to date, and what does that mean? You have everybody today who's furloughed is applying for unemployment. I think that there is a difference between jobs that will come back immediately once the business is open. If you are a nurse at the dentist office or you work at a beauty salon, the minute the shop opens, your job is back. Those are people who I think are short-term job loss. And once we understand that number and how that goes back to workforce, then we'll start understanding a little bit more what is the impact on the long-term job loss. And I think that those are things that I think we all have to take into consideration as we start thinking about how do we open an economy. In terms of real estate, and I'll wrap up with that, and we leave it. I'm sure there's some questions on that. On the residential side, the good news for us this time is we don't have a buildup of inventory. This is not 2008, 2009, where we had a huge inventory buildup that started resulting in a devaluation of homes very quickly. We don't have that, especially in the state of California. And as a result, we don't see any impact short term. That could change very quickly because things could start nosediving very quickly. The biggest issue right now on the residential side is mortgages. People who really still want to go ahead and close on a home, the world of mortgages is getting much more complicated. On the commercial, it's a different story, and I think that there's a lot of discussion that's going to take place over the commercial space, especially with people feeling more comfortable with telecommuting right now and all of the things that we're doing, like we're doing right now, I think that might actually change the view on commercial space. Lastly, I will tell you, from my perspective, out of every crisis comes positive things that will happen. I think that one of the biggest things that's going to happen out of this is it's going to accelerate people's comfort level with using technology by probably a decade. I think that telemedicine is going to be a big beneficiary out of that because everybody's going to be focusing on that. And I think that a lot of what we knew was things that were going to happen in the future, we're going to start seeing faster.
Is that it, Emil? Any other tidbits until we go on to Stuart?
We want to leave enough time. If you have 500 people, we want to leave enough time for people to ask questions and know what's on their mind.
All right, let's go to Stuart. Stuart Gabriel. Let me introduce Stuart. Stuart is Arden Realty Chair, Professor of Finance, and Director of the UCLA Ziman Center for Real Estate, presently housed at the Anderson Graduate School of Management, also UCLA. At the Ziman Center, Stuart applies his expertise in real estate finance and economics to model and analyze trends in housing finance, real estate, as well as urban economics. He currently holds a visiting professor position at the Kohler School of Management at Tel Aviv University, where he conducts research. Earlier in his career, he served on the economic staff of the Federal Reserve Board in Washington, D.C., as a visiting scholar at the Federal Reserve Bank of San Francisco, and as president of the American Real Estate and Urban Economics Association. We look forward now to hearing Stuart's analysis of the impact of this overall economy. Stuart.
Well, good morning, everybody. I hope you can hear me well. Can you hear me okay?
Yes.
Oh, great. Okay. Firstly and foremost, I hope everybody is healthy. I hope everybody is safe. I thank you, Dick, for that kind introduction. I thank you, Mary, and for LABC and for this very informative series. And of course, I'm very happy to join my distinguished panelists, Emil and Victor. I think I can speak for all of us on the line today in suggesting that we're very relieved, we're very pleased to see progress and flattening of the curve of virus incidents. That on the one hand, on the other hand, we've seen the virus again rear its ugly head in places like Singapore and in the crowded migrant quarters of Singapore. So this virus is insidious and certainly ongoing vigilance is required. As Emil mentioned, we're hopeful with respect to medical breakthrough, medical development, antiviral development on the part of Gilead, vaccine development, and many of you may have seen as well that even this week, Oxford University is about to start human trials on a COVID vaccine. Now, on the economic side, what we've seen in contradistinction to the usual slide into recession is a unprecedented, essentially turning off of an economy. A purposeful turning off of the economy as an emergency measure to stop the spread of the virus, to save lives, to prevent the overwhelming of the healthcare system as we saw in Northern Italy, as we saw to some degree in New York City. So certainly, again, as Emil has indicated, we're looking forward to a staged reopening of the economy, which we anticipate be risk-based, be epidemiologically based, and certainly encourage a quicker return of those who have known immunity or those who are lower risk. Now, turning to the economic front. By any measure, the economic carnage is severe. It's unlike anything we've ever seen or known. The numbers are absolutely out of any statistical range. And when you see a decimal point and a number on the right-hand side of a decimal point, that's basically a little joke amongst economists because, of course, we can't get to any degree of accuracy that's anything close to that. But let me mention a few things. Just even in the last few days, first and foremost, the implosion in global petroleum markets, futures prices for oil trading in an unprecedented negative range, spot prices trading in the range of $10 a barrel. This, first and foremost, is an indication of an absolute implosion in demand for petroleum products, and with it, an indication of a very severe recessionary environment as we currently see. In the last month, we saw retail sales plunge by 9%, the deepest drop on record. We saw industrial production fall by 6.3%. Over the last 4 weeks, we've seen new claims for unemployment insurance skyrocket to 22 million. The UCLA Anderson forecast is anticipating 17 million jobs lost to the US economy in 2020. Now with that, we're expecting the unemployment rate to jump both nationally and here in California, likely into the 20% range to levels not seen since the Great Depression. There was a report released just recently, reported on even this morning in the news by LAEDC, the Los Angeles Economic Development Corporation, that suggested that Los Angeles, owing to the particular sectoral nature of jobs in LA, with a very high emphasis on things like hospitality, tourism, entertainment, and the like, that our unemployment rate here in the Southern California region would be on order of magnitude of 30%. This, I'm not sure if we at UCLA got to that level. I think the level we're at is closer to 20%, but it's certainly not outside the bounds of reasonableness. We're anticipating something along the lines of 1.7 million jobs lost in LA County. And of course, this is consistent with a very sharp drop in GDP. Now, with respect to the GDP forecast, the way to understand the GDP forecast is we have a contour of sharp and severe drop in economic activity, followed by fairly rapid recovery. And this contour of forecast essentially mimics the contour of disease incidence, disease abatement, and recovery from disease. So in the first quarter of 2020, the economy fell by 3.4%. The expectation for the current quarter, the quarter of most severe disease incidence, is that real GDP in the United States will fall on order of magnitude of 30 to 40%. Now, again, I said any decimal point here is ridiculous conversation. It's difficult for us to even narrow the number between 30 and 40%. It could be worse, and this based on the fact that, again, any historical guidance is out the window. We're basically off of any chart of any prior activity. But by the third quarter, that minus 30 or 40%, we believe, is going to change to about a minus 5%. And by the fourth quarter, we're going to see the US economy growing again, maybe by about 4 or 5%. By the first quarter of 2021, we expect a surge in real GDP on order of magnitude of 15%. So you see, we're in the severity of virus incidence and the severity of contraction of economic activity currently, but we expect that we will emerge. We will emerge within the next 3 to 6 months. And of course, as Emil has suggested, some will go back to work quite readily, and things will get better. Just a few other comments before I end here, and feel free to give me a heads up with respect to any allocation of time. But there's also a concern, not just locally, but of course in emerging markets. The implosion in oil prices is part of this story. We're going to see huge capital flight from emerging markets, consistent with severe declines in demand for natural resources. We've seen a Fed that's flattened the yield curve. We see a 10-year Treasury that's trading in the range of 60 basis points. We've seen in recent days bond and equity markets go in very different directions and offering in some senses very different signals about the economy. I guess the heads up here is that no one should be surprised if we see further downside risks for equities. Among other news, the capital markets seem to be functioning pretty well. There was initial very wide gaping and risk spreads in the capital markets. Many of those spreads have come back down. Deals are getting done. I'll talk about the Fed momentarily, but a couple of other indicators that are in some respects problematical. We know that LA and Orange County are heavily dependent and exposed in terms of hotel revenue. In both these counties, hotel revenue per available room is down to the tune of 90%. Nationwide air travel is down by 95%. And we expect housing starts in the third quarter to be down by 50 or 60%. And we can talk about that later. And of course, Emil will jump in as we talk about the housing sector. Now, there is some good news on the policy front. And the good news on the policy front is that our government, our Federal Reserve, and our Congress have gone into action. They've gone into action quickly and aggressively with respect to monetary and fiscal policy. So starting first with the Fed, and I just will address this very briefly, the Fed has taken every page out of its 2008 playbook, and it's also added pages to that playbook. So again, they pushed the yield curve, roughly speaking, to zero. They're aggressively lending to financial institutions via the discount window. They've reduced reserve requirements. They've restarted and expanded many of the crisis era programs, including the TALF program, which are designed to restart and sustain lending in asset-backed securities markets, notably including, as Emil was suggesting, in commercial real estate and CMBS, and a restart of markets for both newly originated and vintage CMBS. The Fed is providing dollar liquidity to foreign central banks, taking US Treasuries as collateral and providing dollars. And here's part of the crux of the story. Many people will say, well, what does the Fed have to offer? The Fed is adding ammunition. Interest rates are at zero. We've seen limited efficacy, so to speak, of quantitative easing. What else is there for the Fed to do? And the answer to that question is that there's a lot for the Fed to do. And the reason for that answer is that the Fed has almost unlimited firepower when it comes to provision of liquidity. And bear in mind the metaphor to the engine under the hood of your car. And those pistons, those sectors of the economy can't run except in a crankcase where that crankcase is filled with liquidity. That crankcase is filled with oil. The US economy can't run without liquidity. Liquidity is in desperate need at the moment, and the Fed and the US government are in the business of providing that liquidity. And that liquidity is very, very important locally, nationally, and globally. Now, just another word, and I'll finish here, a word about fiscal stimulus. We saw the largest fiscal stimulus in US history, $2 trillion. First off, as Dick has alluded to in his opening remarks, we're going to see about another $500 billion this week. Of that $500 billion, we're going to see about $320 billion in small business relief. Victor's going to talk about that momentarily. And what we're all hoping Victor's going to say is that this money is going to get to small business with some very concerning data that's become apparent to all of us, where according to data that I've seen, 25% of the $350 billion that was previously allocated went to less than 2% of the firms receiving relief. In other words, it was concentrated amongst some of the best customers of financial institutions, those that are large, publicly traded organizations. This is not the end of fiscal stimulus. As you know, there are massive deficits being run up on the part of local and state government with declines in property tax revenue, income tax revenue, sales tax revenue, and of course, the huge expenditure burdens on local government. I'm sure I've overused my time, so I'm going to stop here, and please excuse me on that, and we'll take it from there. Thank you.
Very eager to understand where our economy is, where we think it's going, what the role the federal government's going to play. And speaking of that, let's now go to Victor Parker. Victor was appointed district director of the SBA's Los Angeles district office in 2011, serving Los Angeles, Ventura, and Santa Barbara counties. In this role, Victor is responsible for delivery of SBA programs and services to aspiring and existing small business owners and SBA lenders and its partners. SBA programs include business advisory services, capital access programs, entrepreneurial development, international trade, and contractual procurement assistance. We are proud to have Victor as a member of our Los Angeles Business Council Institute's Leadership Council on a regional small business procurement initiative. And today, Victor's going to provide us an update on the status of the Paycheck Protection Program and other critical SBA programs helping our small business through this really tough time. With that, I'll turn it over to Victor.
I certainly appreciate it. Certainly, as everyone knows, our small business community has been heavily impacted by the COVID-19 pandemic. All industries, all markets have been severely impacted throughout the course of the last month or so as we navigate through this pandemic crisis. So whether they're self-employed, independent contractors, micro businesses, all across the board, we have seen an impact that has been unprecedented, to say the least, moving forward. For COVID-19 in particular, SBA, and particularly here in Los Angeles and across the country, we've done a couple of things. So number one, we wanted to make sure that we took care of our advisory services to make sure that small businesses had consultants, mentors that they could engage with during this process. As you know, many businesses have had to retool. We have found that they have tried to reinvent themselves. And so our services through our small business development centers, women's business centers, and our SCORE chapters throughout LA and throughout the country have been able to pivot to provide these services virtually, whether it's via conference call or having a Zoom or Skype meeting. We have certainly been able to provide this assistance and guidance, and we see that there has certainly been an uptick to help our businesses navigate the new programs that we have instituted from a lending perspective to provide some financial relief to our small businesses. As most people know, the Paycheck Protection Program is one of those loan programs that is brand new, specifically in response to COVID-19. It is a part of the CARES Act, but we also had the Economic Injury Disaster Loan that was also implemented. So both programs are designed to help small businesses, whether you're a nonprofit organization, again, self-employed, those small businesses with 500 and less employees. And obviously, many of our small businesses, and particularly here in the Los Angeles area, have fewer than 20 employees. And so our programs are really designed to cover that entire spectrum. The Economic Injury Disaster Loan is a loan that small businesses can apply directly through the SBA. Once the appropriation gets reallocated, as you know, that those conversations are in progress, and we're hoping to have some resolve to that later in this week. The Economic Injury Disaster Loan Program goes up to $2 million for small businesses. There is up to $10,000 that is a part of an advance that is forgivable in the Economic Injury Disaster Loan. The good thing about that particular loan program is that it goes can be amortized over a 30-year period. So the objective of that is to make sure that we can make those payments affordable as people recover from the COVID-19 pandemic, as well as defer those payments for 1 year. So it's really, again, designed to help navigate, depending on the nature of your business, up to a $2 million limit. The more popular program, and the program that is getting a lot of activity and where we have really made some great strides in terms of loan volume, is the Paycheck Protection Program. That program is designed up to $10 million, and it has 75% of that is forgivable, provided it is being used towards payroll. It is also designed to provide assistance to self-employed folks, again, independent contractors and nonprofit organizations. Up until the appropriations ran out, we found that in California, we had the most Paycheck Protection Program approved out of the country. So out of all 50 states in the U.S. territories, California had $33.4 billion of approvals for the Paycheck Protection Program. So it's really been kind of the catalyst. California, as usual, is leading the forefront in not only the economic injury disaster loans, but obviously the Paycheck Protection Program. One of the things that we have done is we have re-engaged many of our existing lenders. The Paycheck Protection Program is not done directly through the SBA. You must find a SBA participating lender. Here in the Los Angeles area, we have over 100 active SBA lenders. Many of our existing community banks and smaller banks and banks that are headquartered right here in Los Angeles are a part of that program. However, moving forward, I think we're going to see even more use of the program because across the country, we have added brand new lenders to the SBA. So for those businesses that may not have a relationship with a bank that is an SBA participating lender, we've expanded that portfolio of lending companies that are available to participate in the program. Those folks are now on board. They have been trained and given access to our systems so that they can move much quicker and be much more effective in making sure that we reach all of our businesses throughout the greater LA area to execute and deliver this program. With that, in the interest of time, because I'm looking at the clock and I know we have a lot of questions and a lot of people participating, I'll stop there and allow more time for questions.
As a member of Governor Newsom's Economic Recovery Task Force, what do you think the beginning steps are that the state needs to take to pull this economic crisis out of the hole that was triggered by the pandemic?
For the committee and can't speak for the committee. And then the good news, we haven't started this afternoon as our first meeting, and therefore I'm going to leave it up to the governor and the people for the governor to comment on what happens inside these meetings. But I can tell you from my perspective that one is I think the governor made a very important move by putting together a group of people that really come from a lot of areas where they represent stakeholders, all the way from business, Apple, Disney, others, environmental community is represented, labor is represented, policy making is represented, and on top of that, he has now engaged the all previous governors, and therefore made this a bipartisan task force. I think these are very important steps, and I think that since nobody knows, there's no manual for what we do. This is uncharted waters. I think that what the governor is doing is saying, let me listen to everybody and come up with a plan that's based on knowledge. So I think, as I said, I think the first thing that we need to do is focus on how quickly can we open the economy, because everybody now wants to do it. But how do we do it in a way that actually balances the three sides that I talked about, which is health, economy, and constitutional rights. Unfortunately, I think that no decision is going to be made without some loss on one side or the other. I mean, I think it would be very unrealistic for us to assume that there's going to be a plan that opens the economy that leads to no more cases. I think that there's going to be a risk that we all have to look at and take and evaluate. I think that we also, I think, have to go into this with absolute open-mindedness and total flexibility, because the data will inform all of us as we go as to what the right answer is. And it's still premature and the data is still very, very limited. I think that those are the things that I think we're going to go into it. I think this afternoon will be interesting because this will be the first time that we'll hear from people. But I think we're on the right track. And I think California, as Victor said, California has always led globally. all the way from movies to internet to .coms to startups. And I totally believe that we're going to actually put together a plan that's going to be duplicated, not only by other states, but globally. I think the most important thing is for whatever gets reported and however people are being informed about this, for us not to start looking at every action through a jaundiced eye of politics right now. I think that's going to confuse people more than it's going to help. And I'm looking forward to whatever I can do on this task force.
Thanks, Emil. Emil, well, let's go to. I want to talk about housing for a second. We've had a couple of questions on that. Let's go to Stuart first. Stuart, for several years, California's biggest challenge has been the housing issues, both in affordable and workforce housing categories. What impact do you think the pandemic's going to have on the state's huge critical shortage in the short term and long term? And then coupled with that, I'd like, after you're finished, since we've seen dramatic here in Los Angeles, especially downtown Los Angeles, dramatic construction of infill, urban housing units. Do you think, and this is probably more for Emil, that as a result of the pandemic, are we going to see movements where we leave the urban core, which is very concentrated, and move to the suburbs for more space and distance because of the healthcare crisis? And does the healthcare crisis, in fact, change where Californians really want to live? Stuart, first on the impact of the affordable workforce housing.
Well, Richard, in one word, the answer to your question is that the current crisis is exacerbating issues that relate to lack of affordable supply. It's exacerbating for very straight up reasons. We have diminished production at the moment. It's also exacerbating because we see, as a consequence of this crisis, people falling into unemployment, incomes falling, down payments potentially evaporating in light of what's gone on in equity markets, ability to pay contracting. We've seen some really interesting moves in the mortgage community that relate to increasing FICO scores and challenges in qualification for a mortgage. So all of that together spells, at least in the short run, an exacerbation of issues that relate to affordable housing supply and all concerns that pertain there too. Now, going forward beyond the very immediacy, and I'm hoping that this can be discussed at policy levels, and I'm sure that it will be, there will be great impetus to address those concerns, as there already has been. And one of the things that we see going on right now, perhaps very imperfectly, but nonetheless going on, is a focus on shelter for homeless population. And this is critical in terms of disease spread and all the rest. But those who are the homeless advocates suggest that we're not turning back. And we're not turning back to taking people who we've taken off the streets and putting them back on the streets. So the idea is maybe we'll go back to very, very primitive ideas of, and potentially very important ideas of, instead of looking at housing always as an investment commodity, maybe we're going to remember to look at housing as shelter. And as we look at housing as shelter, maybe we can design policy that will reinforce the idea that we simply need, in an urgent way, to shelter people literally from the storm.
Just to give you an indication, the estimates are in Los Angeles County alone, there's a shortage of affordable and workforce housing of approximately 350 to 500,000 units. And that's before the pandemic. And Emil, as far as the movement from urban cores to the suburbs, what's your thoughts?
Before I get that, first of all, I totally agree with Stuart. And I think that if there's one thing that I think is happening is today we have more highlighting of social inequities than ever because the people who are the weakest link in society are being impacted the most. And I think that if anything, I'm willing to bet that a lot of the focus now is going to be on how do we bring more equity, how do we deal with housing, and the issues that I think have been lingering in the past. I think this, in a weird way this COVID-19 crisis might actually accelerate some of those solutions. I don't believe personally that this will have an impact on people's desire to live in cities in the urban core versus the suburban. Notwithstanding the immediate reaction right now where people might not feel comfortable living in New York because they feel there's a lot of cases. The virus is going to go away one day, and people will forget about what happened during that. And here's why I say that. We have been living in a very interesting environment in terms of what is driving jobs. And in the past, it used to be that employees used to go and pursue employers and ask for a job. What we have seen lately is every CEO is going seeking talent, and therefore, and I've given this analogy, talent to this new economy is what rivers used to be to the agricultural revolution. And if you look at where that talent wants to be, that talent so far has not been interested in the white picket fence in suburbia. They want a different lifestyle. They're sleeping on a couch in San Francisco and okay with it because that's where they feel the think tank is. And I think as long as the new economy is going to follow talent so far is going to go there. Now, there is an argument that's being made, and I am going to wait to see that this virtual business and what we're doing right now might change that, where people can be at their home in suburbia and still be interacting. I personally don't think so, because every time I talk to this new generation, they want to be together. They just don't want to be doing this, and they want the lifestyle. So I, for one, don't believe that long-term this will have any impact on the fact that the globe over the coming 20 years is going to gravitate more towards urbanization.
Thank you. Victor, back to the allocation, the additional 310 billion. I have heard 3, 4, maybe even 5 times in the last couple of days that there is only $310 billion. There's only 2 days worth of funding for small business. How accurate is that? And then how are you going to pick and choose? I think most importantly, I'd like you to hit it one more time. How the mama and the pops, how the nail salons, the hairdressers, the insurance agent, how are they going to be assured that funds out of this 310 billion will be available to them, that they are somehow allocated particularly down to that segment of our entrepreneurs?
No, I appreciate that. That's an awesome question. I think a couple of things are going to impact that. Number one, obviously, the cadence that the original appropriation was spent was quite quick. I think that this one will probably also be quick for 2 reasons. Not only because of the pipeline and the level of need and demand throughout the small business community, but also looking at the fact that we have now added additional lenders. And to that point, the intent is that these additional community lenders and credit unions, et cetera, they're going to be the ones that are taking the new clients that will address the insurance agent, the hair salons, barbershops, Uber drivers, all these folks that may not have business accounts with their traditional institution that they've been working with. These new banks that we have signed on, and a lot of the community banks that we have and credit unions will be able to pick up and close the loop on that. So that is the intent, but that also means that we'll have many more lenders active in the program, which will mean that obviously more loans will be processed at a quicker rate. So Yes, it will go fast, but certainly I think we have done a good job in addressing the need to make sure that folks that don't have, again, these business accounts and maybe banking relationships with some of the traditional 7A lenders will now have a additional group of lenders to go to. And that's one of the reasons why we wanted to set it up so people are not going through what I call lender fatigue, trying to go from lender to lender. That can be very discouraging, particularly in times like this. And so we have set it up where folks can go online and they will actually be able to find a lender near them, and we will include these new lenders that are going to be available to them.
Thank you. Well, let's hope it truly happens. I want to come back to Stuart for sort of a bigger picture. Well, let's first talk about, and Emil, you can chime in here too, what do you think the impact is on our commercial property, on our, we all know that the regional shopping centers are closed, that the retail's so hardest hit. And some of the strip centers I'm involved in, I mean, 17% of the tenants have paid. And they don't have the ability to really pay more. And May 1 is going to be a very, very important date to see how much of rental payments do come in the commercial arena. Industrial, another endeavor, we've seen relatively high percentage of rent payments. Office buildings, it's sort of in the middle. Stuart, why don't you take a stab at what do you think the impact is on commercial property?
Well, Dick, you've done a very good job in a way of answering the question that you just asked. But in a word again, the impact will be varied, and it'll be varied based on, you know, the nature of customer-facing activity, the density of activity, and how we make those adjustments both in the near and long run. I think one of the things that everyone on the line is cognizant of is that some of the trends towards e-commerce were long-standing secular trends. In other words, they were happening well before this pandemic. And some of those trends are going to be very markedly affected in the sense of increasing reliance on, for example, e-commerce, which of course will significantly reduce the demand for retail space, at least for things like classic retail malls, populated by classic big box department stores, things like this. So we're all learning new ways. So again, in a couple of words, where we see elevated vacancy, we see damped rental payments, we see damped NOI, we're going to see very marked declines in property values in some places. We're going to see upswing and default, ultimately some foreclosure, all this part and parcel to the downturn. So much is dependent upon the path of the broader economy. If we have a very bad Q2, but we begin in a select and careful manner, but importantly to open up as we must going forward, we will minimize those costs. And let us hope that we can do that in a very wise way. So thank you.
Emil, you got 23 million square feet of commercial real estate entitlements. What do you see?
Well, look, before COVID-19, we obviously were very cognizant of the disruption of the space in commercial, starting with retail. We started seeing it first in office and how we all started looking at the office space, the retail followed, and therefore, for the last several years, we have started really shifting to what we believe are going to be uses that are going to be more viable in the future, mainly healthcare. And as you know, we have announced our partnership with the City of Hope and really have an anchor right now that's going to be building not only a very significant cancer center and research and a cancer hospital, but what's going to happen around it is going to feed off that, both in terms of research as well as healthcare delivery. And the whole goal is using our communities to start proving up a different way of healthcare delivery. We started talking about Uber healthcare and sensors in homes and all of the things that do diagnostics remotely way before COVID-19, and I think this is going to actually, situation is going to accelerate it. So a big part of our focus on the commercial is really looking at healthcare and healthcare-related entities. And I think if anything today, I'm willing to bet you're going to start seeing many more startups that start looking at issues with healthcare and how do you marry technology with healthcare, with artificial intelligence. I think that's going to be something we're going to be reading about for a long time. The other thing that we've been doing is we basically have turned the retail a little bit upside down by saying it used to be that we would go to a destination to shop. Today, people are going to go to a place for food and beverage and an experience. And oh, by the way, while they're there, they might shop. And as a result, we have been focusing a lot on the experience itself. You know, we have a partnership with Live Nation on an amphitheater and a lot of areas around it that are all experimental. Food and beverage and entertainment, sports is going to be a big thing, and we have the largest sports complex over here. I think that's where our focus is going to be on the 23 million square feet, is looking to healthcare, lifestyle, entertainment.
Thank you. Okay, we're running out of time, and thank you everyone for all your questions, but there's a couple of people who have indicated the same question, so let's try and make it fast. And the question really is, and let's put this to all three of you. Do you see a V-shaped recovery, a U-shaped recovery, or an L-shaped continuing situation in our economy? Let's start with our economist, Stuart.
Somewhere between V and U. In other words, again, it's so much of this is dependent upon the pandemic, upon getting ourselves situated with serology, with antibody testing, with antiviral, with some different ways of coping with the incidence of the virus. I'm relatively optimistic that we're moving well in those directions. And I'm relatively optimistic by second half this year that we're going to see movement out of this, which will accelerate over quarters to come.
Victor, a V, a U, or
I would agree with Stuart. I think it's going to be more of a U, probably a U situation. I think because of where certain hubs are in the country in terms of industry and markets, and I think those geographic factors in terms of how the pandemic is being addressed in those in those areas and how it has impacted already, and that recovery is going to have an impact across the board. But I think that's going to really be part of that driving factor. So I would certainly look at more of a U-shape.
Emil.
I have very bad handwriting, so sometimes I write the V and the U very similar. So I'm not going to characterize it as V and U, but I can tell you what I think is going to happen is I think we're going to see something similar to what we saw post 9/11. I think that the amount of money that is being injected into the system, where the rates are going to go, I think we're going to see a behavior of the consumer that is pretty similar to what we saw post 9/11, which obviously we all know that it led to a big boom for at least a few years before it busted. I believe that I think that the residential market is going to be beneficiary. I think people are going to find homes that they were looking at as unaffordable, not because prices are going to go down, but because mortgage rates are going to go down as a result of where treasuries are. And I think that as we saw in 9/11, we saw a cocoon factor, and we're going to see it right now with the amount of time we're spending. And I think that that if you today look at the amount of capital globally that is looking for a place to be invested, tell me where else would you feel comfortable investing for the coming few years? For sure not Europe, because Europe is going to have a lot of mess on its hands. And I think that this issue with the oil prices is going to have a big political implication. We already were seeing tectonic shifts politically, and I think this is going to only make it worse. So I'm not a believer in Europe. I think Europe is a mess. I think China is going to have to deal with this for a long time. I think India will be a beneficiary, so maybe there. And therefore, I think if you're looking at where's capital going to go to, I think that this is the only place in the world that I think if I want to invest, I would invest comfortably.
Thank you. Well, with that, let's wrap it up. I want to thank everyone for joining us today and our three outstanding speakers. If any of you missed any portion of this and you want to see, rewatch it, you can do it on the LABC website at labusinesscouncil.org. On Friday, LA Business Council will be hosting at 10 o'clock another Zoom spotlight with Congresswoman Maxine Waters, chair of the House Financial Services Committee, and that should be very interesting. And if you have not received an invitation, then go to the LABC website and you can find it there. On behalf of the Los Angeles Business Council, our chairman, Nadine Watt, Brad Cox, our CEO, Mary Leslie, and as well as Rachel Levy and Adam Lane, I want to thank you for participating. Have a great rest of the day. Stay healthy, stay safe, and to the extent you can, stay home. Thank you very much for joining us.
Good job.
Thank you.
Thank you.
Thank you.